lot of new ETFs hit the market last year with big promises and, of course, big income. But hype, well, it only goes so far. The real judge of an ETF is how it performs once the market gets a chance to chew on it. Hold on to your seatbelts, folks. This is going to be a good one. 2025 may go down as a record year for new income ETF launches. There's been no shortage of hype around these new products, so it's worth taking a step back and seeing whether the performance measures up. And that's what I plan to focus on today. Instead of looking at marketing decks or back-tested results, we're going to look at how some of these newer ETFs have behaved so far in, well, real market conditions. We will be looking at two main categories of income ETFs. We'll start with broad Canadian exposure, then move into broad US exposure. For each of these, I've selected a few newer ETFs to see whether they're rising to the occasion or, well, maybe not. A sub to the channel is the best way to evaluate future content. So before we jump into the numbers, let me quickly explain how I'm evaluating these ETFs. Since these are newer funds, I'm not trying to project long-term winners or make any sweeping conclusions. Instead, I'm looking at how each ETF has performed so far, well, in terms of total return, and then comparing that to how its broader category has performed in 2025. For the Canadian ETFs, that means comparing them to the overall Canadian market, and well, for the US ETFs, we'll compare them to the broader US market. This gives us a simple but useful check. Is the ETF keeping up with its market? Lagging behind? Or showing any early signs of doing something, well, different for better or worse? And just to be clear, this isn't about being perfect or beating the market right out of the gate. It's about behavior, consistency, and whether the ETF is doing what it claims to do once real market conditions are applied. So, oh boy, with that all being said, let's do this. Of course, we're going to start. Let's start with Canada. We'll start at home, the broader Canadian market. The TSX had a banner year in 2025. There's no doubt about it, posting a return of 28.24%. Holy banana bread. That's an excellent result, and it will serve as our benchmark. Of course, I need to point out that these are income ETFs, so there is naturally some loss of upside potential. We're not expecting them to match or exceed the benchmark. What we're really interested in is how they compare to one another and whether their performance lines up with the broader market, even if it does come in a wee bit lower. So we're going to start with the Evolve Canadian Equity Ultra Yield ETF. You guys know this one. It's CANY, C-A-N-Y. I've always been a fan of Evolve, and this was an ETF I was really looking forward to. It focuses on Canada's largest companies, and given Evolve's strong track record with covered call strategies, expectations were understandably high. But the real question is, did they deliver? So this one, it has a yield of 19.67%, semi-monthly dividends of 21 cents per unit. And their total return, oh boy, their total return since inception, 7.99%. Oh boy, they only managed to do 28.29% of the benchmark. Yikes. I would have liked to have seen a lot better. CANY has been somewhat disappointing so far, particularly when compared to the overall benchmark. While the underlying ingredients are there and the strategy makes sense on paper, the performance, it hasn't lined up yet. There's room for improvement in 2026, but based on what we've seen so far, this one, well, I'm going to give it a D. I'm going to give them a D. Okay, we will move on to our next ETF, and that is going to be the Hamilton Enhanced Canadian Equity Daymax ETF. So we're talking SDAY, C-D-A-Y. This was a particularly interesting launch, as it was part of a trio of ETFs that introduced Canada's first zero DTE, so 0 days to expiry strategy, with the shorter dated options layered on top of large, high-quality Canadian companies. This ETF looked like it had all the ingredients to be a winner, but did they actually deliver? So this one has a yield of 16.76%, semi-monthly dividends of 18.3 cents per share. Now, what is their total return? This one's looking a little better, 17.90%. So in terms of that benchmark, they're 63.38% of the benchmark. So a lot better, a lot better. SDAY definitely put together a solid showing in 2025, and they did a much better job of staying within range of, well, of that benchmark. While there's still room for improvement, the performance was respectable for an income-focused ETF. As a result, you know what? I'm giving this one a B plus. Okay, up next, we have the Harvest Canadian High Income Shares, and we're talking HHIC. Harvest looked to build on their success with the tech-focused HHIS by introducing a Canadian counterpart in, well, the form of HHIC. The strategy is straightforward. Hold a basket of high-income share ETFs focused on Canada's largest companies and convert that exposure into attractive income. The concept is sound, but did it actually work? Well, their yield, and this one is a little bit on the lower side, so they're not quite as aggressive. 13.42%, and they're also looking at a monthly dividend of 16 cents per share. But looking at their total return, look at this, 24.59%. That's, well, they made it to 87.06% of the benchmark. This is exactly where a fund like this should be. There was some sacrifice and upside, but it largely kept pace with the market. And if you reinvested those dividends, you're getting really close to that benchmark for sure. So that earns his ETF an A, and it would have been an A plus if, well, if there hadn't been another fund that edged it out slightly. And that fund was the 9-point enhanced Canadian high shares ETF. 9-point quietly introduced this ETF, and it's turned out to be one of the more interesting launches in the group. It still offers a solid yield, and it does rely solely on monthly dividends, just like HHIC. More importantly, though, they've managed to really strike a strong balance that preserves upside, and that's something we're about to see in the performance. So their yield, it is coming in at 14.78%, a monthly dividend of 15 cents per share. But their total return, oh boy, 27.80%. So that puts them at 98.44% of the benchmark. Holy banana bread. 9-point really hit it out of the park with ECHI. This fund finished remarkably close to the benchmark, and when you factor in dividend reinvestment, it would have actually pushed right past it. That's top marks for me. So this is our A plus for sure. Oh, what a nice ETF. Okay, let's switch gears and let's take a look at the broader US market ETFs. Of course, the benchmark we will be using for this is the S&P 500, and in 2025, they did 17.9%. And we're going to start, once again, we're starting with Evolve, the Evolve US Equity Ultra Yield ETF. We're talking BIGY, Biggie. Yeah, this one was an interesting launch because it leans heavily into some of the highest and most influential names in the US market. The idea here, very straightforward. Pair dominant high-quality companies with an income-focused strategy and let those giants do the heavy lifting. Expectations were fairly high going into this one, but did the performance live up to that ideal? So looking at the yield, and this is one of the more aggressive ones on today's list, we got 33.24%. It is a semi-monthly dividend of 31.3 cents per unit. Their total return, oh, I don't like to see this, negative 0.97%. So they're basically negative 5.42% away from the benchmark. Biggie has been a clear disappointment relative to expectations. In a strong bull market, a strategy like this should have delivered much more. And it simply did. When you compare the results to the broader market and to its peers, Biggie fell, well, short. And based on that, I have to give it an F, and I don't want to, but I have to. Okay, let's move on to the Global X Enhanced S&P 500 Covered Call ETF. We're talking USCL. USCL came to market with a slightly different feel, focusing on US exposure while putting more emphasis on income consistency. The strategy makes sense, especially for investors looking for regular cash flow from, of course, the US market rather than pure growth. The question, though, is whether that income focus has come at too high a cost or if the trade-off has been worth it. So their yield is coming in at 12.62%, and it is a monthly dividend of 24.5 cents per share. Their total return still on the low side, 6.09%. So that benchmark wise, that takes them to 34.04% of the benchmark. This is the most seasoned fund in today's lineup, and with that comes higher expectations. While the performance wasn't poor, it also didn't stand out in any meaningful way. Giving the results so far, this ETF lands in the middle of the pack, and I'm going to give them a C minus. Moving to our next ETF, we have the Hamilton Enhanced US Equity Daymax ETF, and that has a ticker of SDAY or SDAY. SDAY was one of the more anticipated launches on the US side, largely because it applies a familiar income strategy to a very broad slice of the American market. With exposure to large, well-established US companies and a zero DTE option strategy, this one looked like it could strike a nice balance. On paper, it checks a lot of boxes, but how has it actually held up so far? Looking at their yield, it's pretty respectable, 17.78%, also a semi-monthly dividend of 18 cents per unit. Their total return, well, it comes in a little bit higher, 10.17%. So that is, well, compared to the benchmark, that's 56.47% of the way there. SDAY performed the best in this group, and while there's still room for improvement, it did accomplish what the ETF was designed to do. Deliver income. It's also worth keeping in mind that this fund doesn't yet have a full year under its belt, which does weigh on the return numbers a bit. And keep in mind, that's also true of a lot of these funds we're looking at today. Taking all of that into account, though, with SDAY, I'm going to give them a B+. I feel like that's a fair grade for them. When we step back and look at these newer income ETFs across the Canadian and US markets, a few things become clear. Launch hype doesn't always translate into strong early performance. But when a strategy is well designed and executed properly, it can show up fairly quickly. Some of these ETFs struggle to keep pace with their respective benchmarks, while others did a much better job of delivering what they were designed to do. Even in a strong bull market where upside, it is at a premium. That contrast is really the value of doing this kind of early check-in. It's also important to remember that these are still young funds. A short performance window can skew results in both directions, and none of this should be taken as a final verdict. What it does give us, though, is a clearer picture of behavior consistency and whether the trade-offs being made actually make sense so far. As always, the goal here, it isn't to chase hype, but to understand what's working, what isn't, and where expectations line up with reality. And with that, we'll keep watching how these newer ETFs evolve as they get more time in the market. If you are interested in any of these ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on income stocks. Thank you for watching, and I will see you in the next video.